Hey, good afternoon, everyone. Welcome to the Cornerstone Wealth fourth quarter investment and economic outlook. We're happy you all joined us today or listening on our replay. We're going to dive into the key developments shaping the economy, the financial markets, as we do or have done in the past. We're going to look at the macro, fundamental, and of course the behavioral indicators, as well as go through our investment process. Cliff and the Cornerstone investment team, as well as the advisory team, has all been busy, and we continue to navigate the economic environment. We've seen the persistent inflation. We've seen the recent shift in the Fed Reserve policy. Certainly lots of global uncertainty with the Mideast and Europe, as well as the little thing coming up here in about 12 days, the election. So it's been an interesting time. I know in my 32 years in the business, understanding the trends that are influencing the markets has never been more important than they are today. So we'll take a closer look at the data and what it means for you, our clients, moving forward. As always, joined by our Chief Investment Officer and partner of Cornerstone Wealth, Cliff Hodge. Thanks, Cliff, for joining and all the work you put into this.
Yeah, thanks, Jeff. And thank you, everyone, for joining us today or watching on the replay.
Well, Cliff, lots to discuss, but just a little housekeeping, a reminder, we'll be recording the webinar. Ashley will get it emailed out in the next day or so. She'll also have it posted to our social media as well as our website for you to share with family, friends, colleagues, anyone you think could find it interesting and get some knowledge from it. Also, if you have a question in the chat box, just send us a question, type it in, and we'll see if we can get to a few at the end of the presentation. Our agenda, we're going to cover the investment outlook, as I mentioned, macroeconomic factors impacting both the global and the domestic landscape. Cliff will spend some time reviewing our dashboard. We've been sharing that for the last few years, as well as going over and looking at the fundamentals, valuations, earnings, investment behaviors, etc. Of course, as I mentioned, we'll spend some time on the election. And lastly, we'll kind of wrap up with an allocation discussion as well as investment positioning. Our goal in this session is going to be to provide the clarity and confidence to you, our clients, as the team of Cornerstone act as your advisor for you and your financial lives. Cliff, quite a lot transpired as the quarter. As I mentioned, the Fed gave us that first rate drop, changing the tightening cycle, a little bit of a surprise with a 50 basis point rate drop. We continue to see a persistent inflation. The U.S. economy, though, has shown its resilience as it many times has. We see a stronger consumer remaining stronger, labor market staying stronger, and GDP giving some outperformance, surprise, or expectation. So a lot going on there. We've seen the ongoing debate of a possible soft landing as we still see a slowing economy or slowing growth remaining. The equity markets have experienced a few bouts here in the summer of some volatility or excess volatility. We've seen some mixed economic data. We've certainly seen those geopolitical and some overseas concerns, not just with wars, but a slowdown in China and their economy. So, Cliff, just a few highlights, and I know you go over quite a few of them, but let's jump in and let's get us started.
Yeah, thanks, Jeff. That's a great introduction. We'll get the presentation up here and get rolling. It's out of the way. So, Jeff, as you said, we're now entering the home stretch on 2024, which has been just a great year for equity markets and risk markets in general. The AI-related stocks continue to lead the way, but as we'll see, we've seen some pretty broad participation sector-wise, which is certainly a good thing. We like to see the broad participation in the equity markets. That being said, stocks are expensive. We're near the highest valuation levels that we have seen in the past 20 years. From a sentiment perspective, investors are all in and starting to get euphoric. So some of these factors around earnings, around valuations, around behavior, sentiment indicators, could indicate that there are going to be some headwinds for stock market returns here over the next couple of years. From a growth perspective, the high-end consumer continues to spend, powering the economy. Asset values are at all-time highs. Investment portfolios, houses, so folks that own assets are sitting on nice gains in their financial statements. While at the other end of the spectrum, the lower end has certainly slowed down as folks that have to spend a higher proportion of their income on necessities are really feeling the bite of inflation. When we look at other sectors in the economy, such as manufacturing or other areas that are more cyclical, things that are more dependent on interest rates, we do see that some parts of the economy continue to languish. Bankruptcies are picking up. Delinquencies around credit delinquencies are on the rise, but all in all, still a good picture at the headline level. As you mentioned, inflation is remaining sticky, has continued to make progress toward the Fed's stated goal of 2%, though as we'll see, momentum has stalled over the last couple of months. That's something that we're going to be keeping an eye on and something that the market is really focused on, especially going into the election. The election could absolutely cause some volatility and some noise in the markets short term, though as we'll see, elections, whether it be presidential elections, midterms, things of that nature, are almost largely inconsequential for intermediate and longer term returns. So it's a much better strategy for our investors to focus on their individual financial plan, focus on the macro, focus on the valuation, even though the election is certainly front and center, top of mind for everyone here in the U.S. and around the world. So as longtime clients know, we do on the investment team follow a disciplined, data-driven process which focuses on the macroeconomy, fundamentals such as valuations and earnings, and then that sentiment component, the behavioral component. And as you can see from a macro perspective, a little bit more green on the screen. So by and large, the macro indicators are growing. You see that in GDP and retail sales, a number of different indicators. The Federal Reserve, Jeff, to your point, has now embarked on a cutting cycle. They've already cut rates 50 basis points, which is a little bit of a surprise to markets. Pricing in another cut prior to year end, and then I believe up to 4 rate cuts right now in 2025. Really, the major headwinds are going to be around the fundamentals and are going to be around sentiment. So as we mentioned to kick off the call, valuations, stocks are very expensive. It's very hard to find value really in many parts of the equity markets. Earnings are okay. We are right in the middle of earnings season right now. This week, next week, I believe about 60% of the market cap of the S&P is going to report. So certainly watching that quite closely. However, earnings expectations continue to be extremely high, with consensus expecting about 15% year-on-year earnings growth. With a slowing economy, slowing spending, higher inflation, we think it's going to be challenging to be able to achieve the levels of earnings expectations that are currently priced in. And then from a sentiment perspective, just investors are all in, institutional investors are overweight, and we're seeing some signs of euphoria in the options market and the retail market. So we'll start with the macro, just high level. GDP, the second quarter was actually revised higher in the second revision, up to 3% real GDP growth quarter over quarter. Very solid number. Expectations for the upcoming third quarter, we've got various forecasts, nowcasts here on the right-hand side of the screen, kind of in that 2.5% to 3% range, largely powered by the U.S. consumer and really the high-end U.S. consumer. On the right-hand side, we're looking at year-over-year CPI. This is just the headline number, and as we can see, continuing to make progress year-over-year down to that 2% target from the Federal Reserve. Still a little bit more work to go to get down to that number by year-end. What has been a little bit concerning and somewhat unexpected is that we have now had 2 consecutive months of month-over-month inflation increases. So above expectations, that kind of re-acceleration, largely driven by this rent and shelter component. So that's related to rent growth, housing prices. As we know, the housing market, housing prices have remained very high, very resilient. The labor market. We've talked a lot about the labor market on prior calls. This has been really a laser focus on the investment team from a macro perspective. Really strong report in September, just looking at the actual payroll numbers, nice acceleration. The unemployment rate actually ticked down to 4.1%, down from 4.2, though we are still up off of the lows around 3.5% back in 2023. So the story looks good from the headline level, but when you start to dig into numbers and look below the surface, there are certainly some of these leading indicators we've talked about before still have our attention, whether that be the percentage of workers who are transitioning from employed to unemployed, starting to tick up, starting to break out and get some momentum. You look at consumer confidence around the labor market. How hard is it to find a job? How easy it is to find a job? Those trends from consumers are telling us that perhaps the labor market might not be as strong as the headline numbers would indicate. So we just got an update this morning. Initial jobless claims came in better than expected. But what was interesting is that the continuing claims, right? So those folks who lost their jobs prior, that number continues to rise. And so people that are in the unfortunate position of having recently lost a job, we're seeing signs that it is taking longer for them to find new work, though the layoff rate, right? So people getting fired, that has remained very low, which is a very positive development. Why do we care so much about the labor market? Because going back over a long period of time, it's back to World War II. Anytime we have seen the unemployment rate trough and then rise, there have really not been many occasions or any occasions where it's only come up a little bit and then turned back lower. So we are triggering. We're at the point where we're getting close to triggering some rules that have done a pretty good job of indicating a high probability of recession. Not there yet, but this is the one area where we are going to continue to laser focus. And even though GDP growth remains strong, right? Looking at the quarter over quarter, the year over year growth rates here on the right hand side, we're not historically out of the woods yet, historically speaking. There have been quarters where GDP growth has been north of 3, north of 4, one quarter prior to the start of the recession. So while the probabilities of recession have fallen with the Fed cutting interest rates a little bit more proactively, we're not quite ready to wave the white flag just yet, Jeff. To your point on the soft landing. So that's the macro update, but a lot of data that we're looking at on the investment side.
No, Cliff, thanks for that. There's a lot of information on the macro, and it's been really good information. While you were talking inflation, I was thinking one thing that everybody may be aware, may not be, but the Social Security Administration came out with their increase. So when you're talking inflation, we've seen some pretty significant increases in 22 and 20, a little bit lower in 23, but we're at a 2.5% increase for 2025 for those collecting Social Security. So again, we could see the inflation coming down, but still higher than what we've seen over the last 20 years. So again, thanks on the macro, and maybe let's start moving into the fundamental and the behavioral data you're following.
Yeah, absolutely, Jeff. And as we mentioned to kick off the call, 2024 has been a very strong year for equity markets. S&P up 24%. This is as of a couple of days ago. Really driven by those AI-related themes, right? Information technology, communication, and then interestingly enough, utilities as well, as all these data centers are requiring a lot of power. Utility stocks have actually done pretty well as a derivative of the AI theme. If we look outside of the U.S., the developed markets up around 9, emerging markets up 14, and bonds have done okay, right? Just looking at the U.S. aggregate, up 2.3, have given back a little bit of return as rates have crept up after that September jobs report, and as the market is really started focusing again on inflation and our fiscal budget and deficit situation. But we still think fixed income is going to do pretty well here over the next 12 to 24 months. And we want to make sure that clients understand the role that fixed income plays in your portfolio, why you want to have it. It's to add that stability and then to add some income. And so given where yields are, we do think that fixed income is certainly going to be a meaningful part of portfolios. But the average 60-40 year to date is up around 15. So all in all, really good year for equity returns. Looking at valuations, this is what has our attention on the equity side. So the S&P on the far left, we're looking at price to next 12 months earnings ratios, 22 times forward earnings. That is in the 97th percentile of the data set that goes back 20 years. Another way to think about that is that there are only 3% of the time has the S&P been less expensive than we are today. And that 3% of the time we're certainly at prior readings where .com bubble, 2021, things of that nature, where forward-looking returns likely will be challenged. I would be shocked if we are having this webinar a year from now in 2025 and we're talking about 20+% in the S&P. Anything certainly can happen. Then you look at it from a sector perspective, not a lot of value to be found. Technology continues to remain expensive up near the highs of its bands. Energy actually looks okay. Still cheap. These companies are generating a lot of cash flows. So that is one area that is historically cheap, while the rest of the broader markets remain on the expensive side. So why do we care so much about valuations? Over the long term, valuations are an extremely important part of return expectations. Over the short term, 1 to 2 years, valuations don't really matter. But this is from our friends at Apollo. They did a study and looked at what a forward PE ratio of roughly 22 would imply about 3-year returns. And by their math, we're looking at about 3% annual return expectation over the next 3 years. Now, that being said, if you look historically, a pretty wide range of returns around this 22 level. So 2.9 is probably on the low end of what's likely to be realized. But I think the key takeaway and what's important just to think about is that equity returns, there's an above average chance, a higher probability that equity returns are going to come in a little bit lower than what we've been accustomed to here over the past 5 to 10 years. So as we think about that and what that potentially means, if equities are the predominant growth driver of your portfolio, what are some other areas of the market that we can look to substitute, not all, but maybe a small portion of equity allocations in order to continue to power those returns on a go-forward basis? Things like private equity, things like real estate. We'll talk a little bit about some of those here later on in the presentation. But the key takeaway is that we are likely going to want to be more creative with our portfolio construction decisions to make sure that we are still achieving those high levels of return. And so that's the story from a valuation perspective. Obviously, fundamentals, a conversation around fundamentals would not be complete without looking at earnings. And so on the left-hand side, we are looking at quarterly earnings. The orange line is expectations for the third quarter of 2024, where we are now. Purple line is for the fourth quarter. And as you can see, those earnings expectations are starting to come down. And historically, the market will follow along the pattern of earnings expectations, right? You can kind of see the S&P dipped here and then rallied. This pattern typically holds over long periods of time, but then that broke down around the midway point of 2024. You can see this dip here on the S&P 500. What happened there? That coincided with the Fed pivot. the Fed cutting the interest rates 50 basis points. And so we've seen this disconnect of a euphoric, momentum-driven market, right, and a disconnect between the fundamentals. And that not only holds for the shorter term. We look at the full year estimates. Blue line here is for 2024, the lowest in the history of the series. The orange line for 2025 also starting to come down, though this gap, right, between 24 and 25 is still about 14 or 15%. So that's a big number to fill. And again, it certainly could happen. But as we think about risk and return when managing our clients' portfolios, we always want to think about that relationship. And in our minds, that relationship for equities is not as favorable as it has been. Quick check on sentiment, on behavior. The Federal Reserve tracks household financial asset allocation on a quarterly basis. If you look at this line here, this graph's from Goldman Sachs, equities are now at 48%, which is the highest on record in the series going back to the 60s, only coinciding with the peak of the dot-com bubble in 2000. So households, by and large, are fully invested. We always keep an eye on the CNN Fear and Greed Index as well, which is on the right-hand side. We're, as you can see, tipping into that extreme greed territory. Couple of comments on this. First and foremost, just because markets are overvalued and investors are feeling euphoric and very bullish, does not mean run for the hills and sell your stocks. We're certainly not advocating for that at all. Also doesn't mean that we are going to get a correction here in the immediate future. What it does mean, and what I would encourage our clients and investors to think about, especially as you're having your year-end conversations with your advisors, are there any opportunities within our equity portfolios maybe to dial it back just a little bit, 2, 3, 5%, and perhaps shift that into fixed income or shift that into other growth assets, as we've discussed, to take a little bit off the top from equities. And then if we do get some volatility and we do get this correction that has yet to manifest, then perhaps you have an opportunity to shift back in. That's some of that dynamic asset allocation and portfolio management that we talk about. So again, just want to be clear, don't run for the hills, don't sell your stocks. Just that risk-return relationship that we talk about is a little bit more skewed out of investors' favor at the moment. We turn the page and look at bonds, and bonds continue to look pretty attractive just from an absolute yield perspective. So if we look at treasuries, aggregate bonds, which is corporate bonds, high quality investment grade corporates, you're kind of getting in that 4 to 5% yield range. So that's the coupon payment that you receive. It's decent, right? Not going to set the world on fire. However, if equity markets are going to be challenged over the next 2 or 3 years, that 4 to 5 just from a yield perspective looks pretty good. And then we'll talk about some of the optionality as to some returns that fixed income may produce if the economy does hit some turbulence and perhaps we do slide into a recession. On the credit side, you're just looking at valuations here on the credit side. These are option adjusted spreads. So just think about the rate on a corporate bond versus the difference of the rate in the US Treasury. That spread is kind of like a price to earnings ratio for the equity market. And from a spread perspective, especially things like high yield bonds, corporate bonds, spreads are tight. So when we think about portfolio construction, we are certainly underweight liquid credit, especially liquid high yield credit. But that being said, there are things that we can do in the alternative space. Private credit is a great example where those valuations look a little bit more reasonable. The spreads are a little bit wider. You get higher all-in yield. So on the credit side, we would certainly favor something more like private credit at this point in the cycle, just based on valuations and income expectations than we do on the public side. We'll take a look at that here momentarily as well. But we talk about optionality, right? And so really the major benefit of owning bonds right now in portfolios is the risk return relationship that we talked about it with equities being unfavorable, well, it's actually very favorable on the bond side. And this chart does a great way of illustrating that point. So what we're looking at here is just implied 1-year returns of a 10-year government bond. So 1 year into the future based on different yield levels. So we'll focus here on the US on the far left. Right now we're between 4.5%. So we clip that coupon of 4.5 to 5 if rates don't go anywhere. That's an okay return, right? We're not going to write home about that, but 5% return for little risk is okay. Your downside is certainly more favorable, right? Because the Fed is now cutting interest rates. So there's a cap on how high interest rates are likely to go. So even if we were to float up, say to 5.5%, 6%, which I think is a pretty unlikely scenario, you're looking at single-digit losses. That's not great, but in a recession, compare that to equities, drawdowns are in the neighborhood of 25 to 30%. In fixed income, where we are right now, a single-digit downside number looks pretty good. You get paid 4 to 5 to wait. But really where the payoff comes is if the economy does really continue to slow, if the unemployment rate does start to move higher, the Fed is going to have to get more aggressive cutting interest rates. And so if we get down to a level of 3.5, 3, 2.5, we're still looking at the opportunity for upside of double-digit returns in fixed income. And so again, thinking about that risk-reward relationship, not as favorable for equities, certainly more favorable for fixed income. And if things just muddle through, we get this soft landing that the consensus is latched onto, you're still going to do okay. So we certainly like that setup a little bit better, Jeff.
Cliff, thanks for a lot of information there. And again, just when you talk about the fundamentals or the macro, as well as the behavioral, again, there's a lot of data that you and the investment team are continuing to look at. To your point, right? Just because we see a greedy factor does not mean it's time to get out. We share this with clients, prospects, to be in the know, understand why there's a reason and there's a rationale of some of the adjustments that Cliff, you and the investment team are making behind the scenes. These are not things, we're not day trading, we're not making moves every day, but we're following for the long term or intermediate longer term portfolios that we manage. So and a couple of other things in there, always reminds me of when you talk about earnings, stock prices move on earnings or the expectation of earnings. And you did a great job there, again, looking at where we are with valuations and earnings growth. So, Cliff, we're now 12 days away. Again, I know you want to share some slides. You had it up there. You shut it down. Let's jump into the election. Let's talk about the elections. And, I know you put some great slides together here to discuss today.
Yeah, we'll jump into the election, Jeff. It's funny. I was recently in Canada. Lindsay and my wife and I went up, and that was when people found out we were from America. That was the only thing that they wanted to talk about was the U.S. election. It's like, hey, we just got out. We're tired of all the ads and talking about it. That's all anyone wanted to talk about. So it's a global phenomenon, and we've pulled in just some polling data and some data from the odds markets. As of a couple of days ago. I think these have even changed since I put these slides together, but a very tight race, right? A lot of uncertainty around who's going to win the White House. It's, slightly favors Harris when you look at the Real Clear Politics polling. If you look at the odds market, it's a little bit more favorable at the moment for former President Trump. But what is important and that what we want to focus our investors' attention on is that the outcome of the presidential election is only one factor among many that will ultimately go on to influence the economy and then the markets, right? So who's going to win the White House, but perhaps even more importantly, what is going to be the makeup of Congress? Red suite, blue suite, divided government. I mean, there's so many different scenarios to consider. So we think it is a fool's errand to try and make predictions about what may or may not happen to the broader economy and to the broader markets, over any period of time. And when we look at the longer term data, really that's where we're focused, and that's where we want our clients to focus. Historically, stocks perform regardless of who wins. So we're looking at data. This is average returns over a 2-year period post-election, going back to 1940. There's a lot of positive numbers here, right? Whether it be Democrat president, Republican president, divided government, split Congress seems to be the best case scenario, at least historically. But on average, regardless of who wins, equities typically will perform. And it's really going to be a lot more important for investors, again, to focus on their individual plans. Are we set up to meet our long-term goals? What do the fundamentals of the economy look like? What do the fundamentals of the market look like? Where are there opportunities for us to add value from a portfolio construction standpoint? Because that's really what's going to drive the overall outcome for your portfolio over a period of time. Sure, there may be some short-term fluctuations, but at the end of the day, a lot of that is just noise. And so we would certainly caution anyone, regardless of your political leanings and who may win and what have you, going to cash, getting out of the market because so-and-so became president, historically has been a really bad move. There is a lot of information on the slide. Not going to go through it all, but for those that are watching the webinar on the replay, the slides will be made available so you can read through all of these. But the policy differences for former President Trump are really going to be around taxes, tariffs, deregulation. For Vice President Harris, still likely going to use some implementation of tariffs. Immigration policies are likely to be a little bit more favorable, and corporate taxes are likely going to go higher, which would then fund some of the spending priorities. So, the other thing that we don't know is how serious are these politicians about implementing the policies that they've relayed to their base, right? How much of it is pandering to the base? How much of it can actually be done? Is Congress going to support or push back? There are a lot of factors and a lot of unknowns, but the bottom line is, just looking again over a long period of time, whether it's a Democrat in the White House or Republican in the White House, markets go up over a long period of time. Investment decisions should be based on long-term fundamentals and not near-term political outcomes. So, that is our focus here at Cornerstone and managing your portfolios and keeping an eye on the markets and what's happening, much less in the way of the day-to-day around potential election outcomes. So last but not least, to wrap things up, we're going to do a brief review of our dashboard, some of the changes that we've made here with the release of the webinar today. Some of the major changes: slight downgrade to equities, just overall. Again, doesn't mean you need to go out and sell. We certainly don't want investors to make rash decisions. Tax consequences are certainly always top of mind as well. But again, as you talk to your advisors, are there other things that you could be looking at to maybe take some of the pressure off equities to deliver the longer term growth returns? So in the alternative space, things like private equity, we think are more favorable relative to U.S. equities. The secondaries market as well is an area that you can get some nice discounts right now and likelihood of positive returns. And so if you're not familiar with what these are, if you have not heard these terms, reach out to your advisor, talk to your advisor. We've been doing a lot of work in alternatives, and we think that is going to be certainly more important tool in the toolkit over time as we look to navigate all the complexities of the global economy. We still like fixed income. We have a slight overweight to fixed income, but we want to focus on those higher quality sectors of the fixed income market. We're okay having some interest rate risk. We don't love credit risk, as you can see on the liquid side here. Broadly going to be underweight liquid credit. But what we do like from an income perspective, again, in the alternative segment, is private credit. Very high interest rates right now, good-looking returns, very high credit quality with the managers with whom we work, and add some nice diversification to a traditional equity and fixed income portfolio. Many clients utilize our liquid alternative strategies as well, certainly having a nice year there. And we think that correlation benefit is really what investors should be focused on. One other area of interest, we haven't really talked a lot about it until now. I think real estate is going to look a lot more attractive over the next 2, 3, 5 years. There are some very favorable valuations. In some instances like office and multifamily, we've seen prices decline more than what we saw in the global financial crisis in 2008. There are going to be some shorter term supply dynamics. There's been a lot of building that's been done here over the past couple of years that is coming online now. But we are sharpening our pencils, doing our homework, looking for opportunities in the real estate space, as we think the next 2, 3, 5 years likely to be a little bit more attractive perhaps than maybe even equities, depending on how things go. So a lot more to come on that front, but please do talk to your advisors. Like I said, we've done a lot of work on alternatives, and we are very bullish on alternatives as an asset class here going forward. So with that, Jeff, I will turn it back over to you to take us home.
Yeah, thanks, Cliff. And if do me a favor, Cliff, on your chat, if you can, since you're sharing your screen, can you click on the chat box?
Yes. Just looks like we've got Ashley discussing the Google reviews.
Okay, so I asked you to put that up there. Can we ask ask for your feedback, right? And everybody, if you do click on that chat, you'll see Ashley did put, if you, again, be kind enough to leave us a Google review. She listed out all the, you're sharing your Bloomberg now, Cliff.
Oh, sorry.
But she left it by Charlotte, Huntersville, Aiken, so Greenville, Columbia, Tampa, and Boca. So the offices, if you jump on there and can do us a kindness and leave us a review, give us your feedback. We always appreciate it. Cliff, one question that did come through. One thing we did not talk about, I'm going to say you got like a minute to do it, but question regarding the debt situation in the United States. We've talked about fixed income concerns. I know CNBC they've been throwing everybody on to talk about the Treasury and the concerns that they have. So maybe let's talk, just a couple minutes about the debt situation and any thoughts you have.
Yeah, just really quick, it's a problem. It is not existential today, but that can change, especially if, depending on the policies that the incoming president is able to enact, it can get worse. We are not at a point, we're still the cleanest dirty shirt in the laundry basket, if you will, if you compare us to countries in Europe, Asia, China especially. We've got to get spending under control. We think longer term, one of the easiest ways to combat the debt situation is to continue to let inflation run a little bit hot. So that is a concern for the long term, not an existential threat today.
Thanks, Cliff. And as we wrap up, we've got 68 days. Can't imagine 68 days left in 2024. So just as you're talking to your advisors, or if you have questions, just a couple, and I won't go into it, but just sharing. It's a great time of year. Do some year-end tax projections, review your year-end tax planning. Again, once we turn into the new year, most of the opportunities we have to save money in taxes in 24 is gone. Not all, but most of them. So again, review your 401k contributions. Make sure you're maxing out. If you're under 50, 23,000 if you're able to. If you're over 50, you got the 30,500 with the catch up. Again, if you can do IRAs, that is not one that you have to do before year end. You can wait until tax time, but good time to be planning for those. And that could be IRA or Roth IRAs. Cliff, you and the investment team have done a tremendous job throughout the year. Tax loss harvesting. So internally, we've already done a lot of the harvesting. But if you have outside accounts, good time to look at your outside accounts. or if you have tax loss carryovers, let's talk about it. Great time to review. You only can write off or take up to 3,000 of losses unless you have enough gains to offset the gains against your losses, but you can only take a certain amount. So make sure we understand what those that opportunity. Charitable, again, we've certainly dealt with some major hurricanes in the Carolinas as well as our Florida offices. Charitable contributions due to the hurricanes have been increased with Helene and Milton. So good time to look at your charitable donations and your charitable inclination. You could also look at qualified charitable distributions from your IRAs if you're over 70 and a half. So again, great time to review those. And one last good time of year to look at Roth conversions. Tax laws will change no matter who our president will be. Again, 12/31 of 25, they are set to revert back to what they were in 2017 with the highest tax rate at 39.6, currently at 37. So Roth conversions are a great thing to be looking at over the next year and beyond, but take a look at all those options. So again, on behalf of Cliff, myself, the Cornerstone team, we thank you all for joining us today. We appreciate your trust. We appreciate the confidence you place in each of us. No, it is not taken lightly by anyone of the partnership or our staff and team. So we thank you all. We wish you a happy Thanksgiving. Can't imagine. Well, maybe we'll start with happy Halloween, happy Thanksgiving, and happy holidays, everyone. If we don't talk to you before, we look forward to seeing you in the new year. Have a great rest of your day and a successful finish to the 2024 year. Thanks, everyone. Have a great one. Thanks, Cliff.